I think the issue in Australia is that you do have a very sharp re-acceleration in some of the big national income type measures of the economy. So the nominal parts of the economy are re-accelerating at the moment. If you're a wage earner, you're just not feeling it yet. So the lags are quite long and a little bit elastic. I think from a central banker's point of view though, rates got to where they were as partly insurance. You know, they didn't know how far the compression in national income was going to be. They didn't know how far the falls in investment were going to be. They didn't know how far the damage to the fiscal finances were going to be. And they had a much more uncertain global environment. So working backwards, I've got a lot more confidence in what's going on globally. In fact, all throughout the G20, everyone's growing above potential and in some cases accelerating. So global growth isn't that far away from 4% real growth again. It's just that everyone thinks that they're stuck in secular stagnation. In terms of the other parameters, business investment's quite close to basing out more broadly. If you strip Western Australia out of the national calculations, the rest of the economy is growing about 3.6% real, which is well above trend. So a lot of what you're seeing in terms of the damage to the data, even the wages data, is a Western Australia event. And what we do know with quite a lot of clarity is that Western Australia will turn quite sharply through the remainder of this year, just as the LNG volumes really kick through and spreads down somewhat into the rest of the economy. Housing, yes, it will be a significant drag as we move through into 18 and into 19. But even if you put through housing contractions the size of 91, 92 or 94, 95, it would still leave growth on a positive trajectory if you strip out the huge drag that we've had from business investment. So business investment just moving sideways adds back essentially 1.5% for growth. The biggest falls in housing investment, what that has ever done at any period for economic growth in a single year is less than 1%. So I think as long as the consumer can hang in there, and they're, you know, in some ways, you know, the consumer's doing reasonably well outside of specialist retail. So I know all the headlines are on specialist retail, but the consumer's doing okay. The rest of business investment's starting to pick up. Government wants to contribute a little bit more in terms of infrastructure spend. The export side should be contributing to growth reasonably significantly. There is a prospect that the headline GDP number here, after this quarter, starts to look a little bit better. Does the inflation pick up sufficiently is going to be the real question, and does the wages pick up sufficiently? Again, the lags are long. We think we get the evidence of that locally really late this year. So first phase of next year, as Brett alluded to, there's a range of central banks, Canada, Bank of England potentially, even the Reserve Bank of India is not that far away from thinking about hiking, which could potentially be looking to all hike simultaneously. Does Australia fit into that basket? Potentially, if the data comes in as sufficiently robustly. But I think that uniformity of that next step, no one wants to be the next cab off the rank after the Fed. Yeah, I think you'll find that a lot of central banks will go simultaneously.